welcome those of you in the room and those of you virtual. We're very excited to have you guys here. I'm not sure how many years we've been doing this, but it's been a great event to be able to see faces and to talk with you guys in person, and the folks online. We're glad you're able to join us for this. Our tax group has really grown a lot in the last few years, and so I just want to take a minute to talk about that. The firm itself has grown. We're over 500 attorneys now. We got 70 just in the tax group. We've got folks in 13 offices and focus on, not used to maybe be sort of focused just on federal income tax planning and state and local. We have benefits. We have estate planners. We've got people doing fiduciary litigation, tax litigation. So we really rounded out our group. And so if you have any tax needs, we hope you'll reach out. What we're here to talk about is, here's our agenda. We're going to hit on renewable tax credits first, and then we'll proceed through the rest of our wonderful agenda. If people have questions, probably best to ask them as we go rather than wait till the end. We are looking forward to, though, getting to talk with you guys afterwards at our happy hour. So for CPE and CLE, I'm sure some of you are here for that. There's information in the packets that you've received. There will be, in particular for the CP, there are these polling questions. When we get to those slides, there is a QR code. There's also a URL. You can either, pull out your phone and snap a pic of the URL, or enter the QR code, or enter the URL. Either one will take you to a Microsoft form. You can then enter in your answers. All the questions are on one form, though, so keep it open throughout the entire program rather than closing it out, because if you close out, you'll have to start over. So with that, I think we can start on our actual topic. So the renewable energy credits, we'll start off with our first polling question, because the first thing we're going to talk about, really the main thing we're going to talk about, is the IRA. I'm going to pause on this since this is your first opportunity to open that Microsoft form. The question is, when was the IRA signed? Give you a hint.
Sorry, do we need to do that?
If you want CPE, yes. CLE, no. So we have some dates up there. All of them are 2022. So in any event, it's well past. Whatever you think, I'll give you a hint. The answer is D. So the IRA, I'm going to go ahead. I think people have had an opportunity now to load that up. The IRA, the Inflation Reduction Act, what it did with the renewable energy credits is it really created a whole bunch of new requirements to obtain them. It extended them quite a bit, but it also added these new requirements. It basically said, look, if you don't do our requirements, you're not going to get as significant a credit. So it actually moved the credit down significantly, whether it's PTC, which is shown up here, or the investment tax credit. It also reduced it by 80% down to, in the PTC area, 0.3 cents, the ITC, only 6% of basis. And then it said, but get back there and perhaps even get more of a credit by complying with these new requirements. New requirements including prevailing wage, apprenticeship, domestic content, energy community, and in the ITC area, low-income community. So what we're going to focus on today is the new rules that have come out since our last Denver Tax Conference on these different adders and qualification requirements. The basic rules from the statute are in your material. We're not going to focus in on those today. We're going to focus more on the regulations and notices that have come out in the last year. All right. I'm going to skip ahead to our first slide on the proposed regulations on prevailing wage. But before we can get into that, I'll just give you a basic idea. Prevailing wage is this concept that in any particular locality where you might have a project that would qualify for the credit, you have to pay the laborers and mechanics, that's a defined term, that are doing construction, alteration, or repair, that's a defined term, on your project, the prevailing wage, meaning the wage that the Department of Labor says that kind of person should get paid this amount. That includes their base pay and their fringe benefits. So the Department of Labor has a website. You go and you put in your county. For these types of projects, it's generally heavy construction, and you can find out, for an electrician, I got to pay $25 an hour, for example. So the proposed regulations helped us by giving us some additional context around some of those defined terms and how one would implement this. So in terms of that first defined term, construction, alteration, and repair, the IRS decided to follow the Department of Labor rules. And the Department of Labor rules say that the construction, alteration, or repair has to be the work that's done on site. That's the main impetus of that definition. And so you then have to go further and look at how the Department of Labor defined the site. And that's where you get some of these other requirements of secondary construction sites, meaning, okay, here's where we're going to put the wind facility, but we're actually going to, put the turbines together, in a laydown yard next to that. That'd be your secondary. And support sites. So that would be where you go to, if you're constructing, say, culverts, I had that come up. If you're constructing culverts for the project at yet a third place, that's considered the site, even though it may be 100 miles away from the actual wind facility. So if you're in any of those places and you have people essentially working with their hands, that's how I sort of shortcut the mechanic and labor concept. If they're working with their hand, then they have to be paid prevailing wage. In terms of repair and alteration, the IRS rules also told us that repair and alteration is not maintenance. But the line between maintenance and repair or alteration is very gray. So fixing something that isn't working, you think, well, maybe that's maintenance. But if it's completely malfunctioning, if you have to replace it, then that's repair. If it's a light bulb and it's just ordinary changes, then that's maintenance. It's a totally different definition at the Department of Labor, which is what we have to use, than, say, the differentiation between capitalization and deduction. So if you touch any of these things, you have to be able to differentiate what you're bringing up. So the next slide I'm having trouble because I was going to have it on my iPad, but I don't. So the next slide talks about when you look at the wage determination. So the wage determination changes from time to time, right? The Department of Labor looks at what are people paying in the locality for, say, that electrician, and from time to time will update that rate, almost always upward, of course, but they will look at that. What the proposed regulations did was say, okay, well, when you begin construction, alteration, and repair, that is the date on which you look at the prevailing wage, and that applies throughout the construction period. There was a lot of question about that initially because these rules, the Department of Labor rules, came from Davis-Bacon. Davis-Bacon is government contracting. And so in that area, the wage is when you sign the contract with the government. And we don't have a signing of a contract with the government here. We have private parties acting. So instead, the IRS decided it's when you actually begin construction, alteration, and repair. And anyone who's working in this area might here, begin construction and sort of turn off after that. Begin construction is a wholly different test. This is beginning construction, alteration, and repair. So again, an easy way to get confused, but a differentiation. There are not yet a lot of wage determinations that apply to projects that qualify for these credits. So an electrician, sure, most have that, but most do not have wind turbine technicians or a wage determination for a racking specialist in a solar project. So the Department of Labor and IRS have worked together and come up with this idea of a supplemental determination that you can apply for with the Department of Labor for the Department of Labor to tell you, okay, this is the rate. And as long as you pay that rate or bring the people up to that rate once you receive it from the Department of Labor and do it within a short time, they won't consider that to be a failure where you have to pay penalties or interest. But until you receive that, you have to be paying what you submit to the Department of Labor as what you think is the prevailing wage. There are also those situations where you cross counties and things like that, department and wage determinations can differ. The IRS said pay the higher. They also told you there's no special rules. The Department of Labor has, it has to be weekly for a Davis-Bacon project. For the IRS said whatever your normal, if it's weekly, if it's bi-weekly, if it's monthly. Most of these construction projects pay weekly, but you know, if there were somebody out there with other regular practices, the IRS allows for that. So the IRS also issued helpful regulations in the apprenticeship area. Apprenticeship requirements have 3 requirements in the statute. You have to, if you have at least 4 people working on site on the project, you have to have at least 1 apprentice. That's requirement number 1, so participation. Requirement 2 is that at least a certain percentage of the labor hours going into the project have to be from apprentices. And 3, there's a ratio that you have to comply with, which is really safety driven, that you have to have a certain amount of journey workers for each apprentice on site. That's determined by the state. It can be determined by the apprenticeship program, but it is based on that. And the IRS gave us some helpful rules that, in particular, the statute says if you fail to meet the participation test or the hours test, you have to pay a penalty to the IRS. If you meet the ratio test, the statute was silent. What the IRS did with the proposed regs, probably one of the best things, was saying, well, if you're missing the ratio, then you have to treat those people that otherwise would have been apprentices as journey workers and pay them prevailing wage, not count their hours as apprentice hours. And as long as you do that, you're fine. It can trip you into penalties, in which case, because you underpaid them for prevailing wage and you didn't realize it until after you did the ratio for the day. And so you can have situations where you get into penalties because of that ratio test, but at least there's a way to address it rather than simply losing your credit. So I'm going to skip forward and let Colin, there's a bunch more in your material. We have a really condensed amount of time. And so I would be, anyone who wants to talk about this stuff, I'm happy to talk for hours. But since we have a short time frame, I'm going to skip ahead to domestic content. And go ahead, I'll find the slide.
Okay, it's 19.
19.
Thanks, Adam. Yeah, I'm going to try to cover 3 additional adders or bonus credits in a very short amount of time here. So as Adam talked about prevailing wage.
Sorry. Go ahead.
Oh, I see. There were, yeah, the
Additional
numbering.
slides.
Okay. Adam talked about prevailing wage and apprenticeship being a way to multiply your base credit amount. These next 3 adders are ways to add additional percentages or additional credits to what your base amount is that you calculate. The domestic content adder is 10%, additional 10% if you meet the requirements. It's under section 45 and 48, and then starting in 2025, 48E and 45Y. And we received some helpful guidance here in the form of a notice 2023-38 in May of 2023. And in that notice, the IRS gave us a bunch of pretty complicated rules for how to determine if portions of a project are made or constructed out of domestic materials, basically, if they're sourced with U.S. Processed materials. And so they essentially broke it down into two main buckets, and you've got your steel and iron, which are like construction materials that are structural in function and that are primarily made of steel or iron, and then manufactured products. So there's two ways that you have to analyze what your project, your facility looks like. If you've got construction materials, 100% of those materials that are structural have to be made of U.S. produced steel or iron, and there's no real way around that. Little subcomponents like nuts and bolts do not have to be sourced in the U.S. But then when we get into the other side, manufactured products, it gets quite a bit trickier, and you kind of have to look at like the manufactured product itself, which is going to be like a big machine that you're putting into your facility or installing as part of your facility, like wind turbine or power inverter or something of that sort. You have to look at the product itself and then analyze each component of that machine or that manufactured product and determine where those components were manufactured. If you've got a certain number of them, say you're looking at a wind turbine and you've got nacelles and the rotor and like the blades, each of these are going to be considered components of the manufactured product itself. And you have to look at where each component was manufactured, add up all the costs of each of those components, and then divide it by the total cost of all the manufactured products in your facility. And so the main issue that we've seen is it's difficult to obtain costs from a manufacturer. If you've got someone in South Korea or something that's manufacturing a large, very expensive piece of equipment, we've seen they're very reluctant to be giving up confidential information or information that they don't necessarily want to release as far as how much it costs to actually produce the product and along with labor. So we've seen some issues come up there and tried to come up with some creative solutions, but we're kind of not sure exactly how all that's going to fall. The next slide has a bunch of what the IRS in the notice calls safe harbors, and in order to put your components into the two buckets, you have to decide steel or iron or manufactured product. And this is just a way the IRS has said, hey, if you've got steel racking, you know that that's steel or iron. So 100% of that is going to have to be U.S. produced. If you've got a tracker, that's going to be a manufactured product. Then you have to go down that whole test. So if you can go now, Adam, to the next couple slides. Next one.
Yeah, I think I'm gonna actually just take a few minutes to talk about the transferability, because I think that's probably, if you're not working with developers on a regular basis. Oh, I should pause here. Talking about direct pay and transferability. If you still might, as advising just any taxpayer, get into touching this area, because now tax credits are saleable. There are developers out there that are just trying to sell. There's portals going up on the web where people are getting matched to buy and sell these credits. It is one of the key things that came out of the proposed regulations that came out on transferability is passive activity loss limitation. Those still apply. So to the extent that you're buying a credit, you will not be able to be active in area that generated the activity rather, that generated the credit. There's no grouping allowed. So you either need a client who is not subject to 469, or you need somebody who has passive income to be able to use the credit. But if you have that, if you have a non-closely held corporation, for example, I think a lot more people are starting to get into this area of renewable credits, both because it helps them look green, but also because they're able to reduce their tax burden. Credits are going to sell, we think, somewhere in the 80 cents to 95 cents per credit. So if you can, chop 5 to 15 cents, 20 cents off your percent off your tax bill, that could be pretty powerful. And so we think a lot of people will get into this area. It's also an alternative to tax equity financing, which is what this question is getting at. Hopefully everyone's gotten a chance to answer. But tax equity requires you to enter into a partnership. It requires you to stick around for the entire period, whereas transferability allows you to buy and sell on a annual basis, on a per credit basis, etc. I'm going to go to direct pay applies to basically tax exempt governments. If you represent those kind of entities, then direct pay might be something that's useful. There are a few credits, carbon sequestration, hydrogen, and advanced manufacturing that do allow for some direct pay for everyone, but I don't think most people will be in there. So I'm going to skip past direct pay. We're going to bring it into credit transfers. Go to the regulation highlights for transferability. So anyone who's not a tax exempt and not a government can participate in the transferability, either as a buyer or as a seller. Partnerships can participate. It does require a pre-registration. The IRS promised that this, Yellen herself actually said the portal to register would be out in the fall, which is now 1 week left. So hopefully sometime next week they will release that. They will release the portal, but they have yet to do so. So I don't know what that looks like. I was hoping to be able to talk about it. We don't know if it's going to be sort of a audit light, audit it full, or just check the box. Yeah, I think I qualify, and this is where my project is, and so give me a number, kind of like an SS4 or something like that, where you just say, here's my, here's who I am, give me a number. I suspect it'll be that last category. Another aspect of the proposed regulations is this vertical slice. So you remember that stair-stepping slide that I showed you? If a developer says, oh, I qualify for that maximum credit, I did energy community, I did domestic content, I did prevailing wage, I did apprenticeship, they may have. But if you buy a credit from that project, you're buying a piece of that entire credit. And so if any of those fail, you will, as the buyer, lose out on a portion of that credit. So even though there might be a different kind of risk, Colin was talking about domestic content and this difficulty of what's steel, what's manufactured product. Making those determinations can be difficult. There's risk associated with that. You can't just buy that risk or avoid that risk. If you buy a project that says they did domestic content, you're buying a piece of that risk. There's also a requirement, yeah.
That factored into the 80-cent pricing, or is there going to be indemnification?
So I suspect there'll be indemnification either way, right? And some people will go out and seek tax insurance to try and address it also. I think tax insurance is going to come into this area in a big way. But it also, in part, goes to pricing, right? I think the more hair there is on the deal, the more likely you're going to see pricing come down. So investment tax credits have hair because they have a recapture concept. And so those are where we're probably going to see more like 80 cents, because you not only have domestic content risk and whatever else risk, you also have the issue of recapture. So good question, because that was one of the things I wanted to talk about, and we're out of time. Thank you. Any other questions before?
What was the answer? The question.
That it would likely impact pricing, yes.
Heard similar percentages on how much people are paying for them and the insurance idea, but have you heard where the insurance is
Like how expensive that is. So I was at a conference month and a half ago, and they had a bunch of panels actually from. Well, there was one panel in particular that I went to that had underwriters and representatives of like Marsh, stuff like that. They were saying like 3 to 4 cents. Now, I don't know who ends up bearing that. That's another question that they didn't really address in that presentation. Because, if you're paying 80 cents, it may be buyer. And so you're really paying 83, 84 cents, right? When you add in the insurance.
Yeah.
Any other? Great. So I think Bob, you're up next. Bob Keating is going to talk about ethics in AI. On these renewable credits, there's a whole bunch more. We had a very active year. We're going to have a very active year end. We're expecting a lot of regs to drop. So we'll have lots to talk about next year. Let me find your slide. You want to go ahead?
There you go. All right. Thank you. Hi. So we are now going from not going to say the mundane to the sublime, but more from the sublime to the mundane. I'm going to talk about ethics as they relate to AI. And I'm going to talk about them essentially related to professional ethics, particularly focusing on the ethics that apply to lawyers and accountants. Starting out, my perspective on this is basically that which was derived when I got my first computer. And when I got my first computer, something interesting happened. I was very concerned that the computer wouldn't do what I wanted it to do. And I think you've all had the same experience. The computer absolutely did what I wanted it to do. What it didn't do are the things that I didn't know I wanted it to do before I had a computer. And we've been through a variety of things. I'm going to touch on those real briefly, where we've gone through that experience. And now we are going through an experience of trying to come to terms with what I'm going to refer to as Gen AI, or generative artificial intelligence. Gen AI can be thought about as kind of a new tool. And the effect of this new tool sort of fits between somebody giving you a new stapler and somebody giving you a new computer program that if you push Alt Control Delete, you'll create a thermonuclear disaster. So I think that there's a lot of room for learning here. And what I've tried to do, and I've tried to do it in the slides, but I also have a written document out there that has a lot of references to the sorts of high quality legal research that we're all going to do, principally podcasts, which is where I think a lot of us have learned what's going on and amplify on a lot of the terms that I'm going to talk about as we go through this. We're talking about generative AI, and it includes a whole bunch of different kinds of things that basically relate to applying artificial intelligence to generating. For us, it'll be words. It's also true of graphics. It's also true of computer programming. There are a lot of different names for it. And the interesting thing on this is that I tried a couple of times to keep track of the names, and the names change daily. The programs change daily. Day before yesterday, Gemini came out. Something else came out yesterday. And so a lot of people are throwing this into ChatGPT, but ChatGPT is not the only generative form of AI. My favorite is actually one that one of our favorite people, Elon Musk, has come out, referred to as Grok. And Elon talks about Grok is modeled on the Hitchhiker's Guide to the Galaxy and so intended to answer almost anything and far harder, even suggest the questions to ask. Grok is designed to answer questions with a bit of wit and has a rebellious streak, so please don't use it if you don't have a sense of humor. And then comes the part that I think might implicate some ethical concerns. A unique fundamental advantage of Grok is that it has real-time knowledge of the world via the X, formerly known as Twitter, platform. It will also answer spicy questions that are rejected by most other AI systems. What could possibly go wrong? I think it's interesting, Goldman Sachs, and these are all, there are footnotes to this in the materials. Goldman Sachs says that generative AI will expose the jobs of 300 million users, and that it will increase the gross domestic product by 7% between now and 2027. There's a lot of discussion as to what this means. I'll say a couple of things about it, but I refer you mostly to the materials. I think what's interesting here is that when you read the descriptions of how it's going to affect people, it's not necessarily going to destroy jobs, and I'll mention that in a minute. But the thing that I had not been aware of is that apparently generative AI is as expensive to run as cryptocurrency. And there's a report by a Dutch physicist that says that by 2027, the power necessary to run generative AI will be equal to the power currently being consumed by the Netherlands. So thank God for windmills. Run through a couple of quick terms. AI is basically an autonomous model that makes decisions. Generative AI, we've already been talking about. Artificial general intelligence, and you'll see there are two G's and they sometimes get confused. We have generative AI out in the world today. We do not have artificial general intelligence, AGI. AGI is essentially what corresponds to human intelligence, not limited by a particular discipline. That is, when I'm sitting up here talking about tax issues, I can be thinking about Shakespeare, or I can be thinking about different things having nothing to do with tax. General AI, AGI, is one of those things that is both really hopeful and really frightening. And this is what people are trying to get to. They haven't gotten to it yet. Large language model, just because we don't have enough abbreviations that start with LL, they thought they'd throw another one in here. And what that is the text on which the generative AI is drawing to provide its information. In GPT, P means pre-trained. That means that the model has been working on a data set, and generally that's an LLM. A transformer is using what they call coders and decoders to then manipulate the AI that it's looking into, the amount of data that it's working on. Hallucinations, which you've heard a lot about, and you'll find discussions of the court cases that are dealing with this right now in the materials. This is something that is simply incorrect that the AI generates. And the AI generates a lot of incorrect information, and a lot of people are working on it. And an API is a useful term that you'll see a lot. It's basically a way in which AI and the generative function of AI relates to other programs. So we'll do our first and only question, and that is, have you used general AI? And for those of you out in video land, please answer that, and eventually we'll get an idea of how many people have used general AI. I will, in a moment, mention what I consider to be the answer to that question. Okay, here's I think, a useful slide that just sort of talks about how you get farther and farther into generative AI. And there's a lot of artificial intelligence that does a terrific number of things, and that's then gone into machine learning, where people are beginning to make predictions, and then deep learning, and then ultimately generative AI, which can generate already some pretty impressive both text and image outputs. The way in which generative AI works is very similar to what we have all been doing with Google and Bard and things like, or Bing and things like that. There's a prompt, a response, and so we put the question in and it gives us a response. What's unique about generative AI, or the current version that came out about a year ago, is the chat function. And the chat function lets you re-query and refine the discussion with the AI. In the outline, I have a number of chat examples where I asked a question, got a response, and responded further to the question. We went back and forth. And there have been some really useful things that I have at least found when I use AI in this way, just in terms of kind of refining my ideas, having an opportunity to have an argument with somebody that I'm not worried about annoying. So it's the chat function that I think really kind of adds the zest to what AI is doing. For example, and this particular chat is included in full in the outline, but I was here trying to compare Claude, which is the Anthropic AI form, to other AI models. And in a second, we'll talk about the way the different AI models are working right now. And it gave me a bunch of responses, and I said, oh, we'll compare it with you. And then it said, well, I don't have really enough technical information about myself to be able to explain it to you. But I can tell you about the wonderful things. And then it goes on, and you can see this in the materials. What AI isn't, and here is where I think people are getting into a lot of trouble right now. AI is neither a search engine, nor is it a mathematical calculator. It connects with search engines and mathematical calculators using APIs, which we talked about, but it doesn't do it on its own. It is wonderful at summarizing, expanding rhetoric, and translating. And for this particular group, I brought a copy of a translation that it did for me, translating the language of the capital account maintenance rules, which I often refer to as the 23rd Psalm of subchapter K, into into Old English. It's really good at that. It's really good at summarizing. And, you know, you have this available on a lot of the Bing programs where you can pull up Copilot. And I personally find myself from time to time, more frequently perhaps than I would like, reading the 85-page Supreme Court opinion that upholds the 178-page Chancery Court opinion in Delaware to understand what the rules are governing business organizations. I can ask it, and it can, in seconds, give me an idea of what this case is about. It's really useful in that sort of thing. It is also useful in terms of kind of working with your language. You know, are you doing something that makes sense? Does you know, if in fact you come to disagree with something, it can give you good arguments on the other side. It also knows something that I wish I had been taught, that Lincoln was taught, that Shakespeare was taught, but we no longer teach rhetoric. And I think rhetoric is one of the great underlooked and overlooked functions of the English language. And this is something that you can actually draw on. And I've got an example in the materials where I responded to, again, Elon Musk's comment about we should pause development of AI. And I responded in irony, by metaphor, by simile. I think it's really a useful thing. And again, this is more than just playing games. I actually learn something from looking at it, and I find it helpful. But AI, like way too many of us, it's often wrong, but never in doubt. Now, what's going to happen to us all? Here is what Goldman Sachs says. It's going to have an effect on various people throughout the world, and you can see that it's going to probably have an effect of 44% of the legal professionals and business operations, 35%. It's going to probably cost some jobs. It's certainly going to change some jobs. I know it's already changing what I do. If you're really worried about it, I strongly suggest that you go into building and grounds cleaning and maintenance. They're safe. Goldman Sachs says they're safe. The comment that I have heard repeated by a number of different people in a number of different contexts is tax professionals will not lose their jobs to Gen AI. They will lose their jobs to other tax professionals who use Gen AI. And I think there's really something to that. It's worth thinking about that. If you truly want to do something, if you'd like to have an occupation that's going to benefit you in a new AI world, what you want to do, surrender your license and go study to be something called a prompt engineer. Prompt engineers are a drug on the market right now, starting a couple $100,000 a year. And you can wear sneakers. But this is, you know, I think that what we all want to do is become a lot better prompt engineers. And I think that's really kind of the trick on this. I've got a number of things that, you know, I've gone through, and as I've watched the various changes, this is something where I feel there aren't many things that I can count as being beneficial, being my age. But having been through all of these, I have seen, as we used to say back in, I know this is very 20th century, but when the paradigm shifts, it's worth having thought about the last time the paradigm shifted. I've got rental scooters up here because rental scooters are a perfect example of what's happened with generative AI. You know, rental scooters, you know, these are the wire coat hangers of the sidewalks, just got dumped there by people. OpenAI just dumped ChatGPT 3 and ChatGPT 4, and people just started using it. That's what's happening. Basically, these are things that are sort of coloring outside the lines. Needless to say, this sort of chaos has given rise to a lot of worry. So, with all of that as background, I am now going to run through the ethics considerations that I think you need to worry about. There are ethical rules dealing with the relationship of lawyers with clients and ethical rules dealing with societal issues. With respect to lawyers and clients, I think there is a duty of competence, and this is what people get into trouble with more than anything else. And the duty of competence means that you need to proceed, you need to know what you're dealing with, but you can't ignore this in that context because your adversaries and your clients are going to be dealing with this. You need to understand the technology well enough to communicate with your clients. There is a duty to supervise. There's a question here as to whether Gen AI is a technology or a person. And I have people shake their heads when I say, well, you know, people are thinking about this as a person, not as a technology. And, you know, it is being treated as a person, and in that regard, I would refer you to a recent tax court opinion called Piper Trucking and Leasing versus Commissioner of Internal Revenue, where a court said that supervisory review was not required, even though the statute required it when an assessment, assessment was being made. A person must review this, but if it's being made completely automatically by the CAWR program, that does not require people to go through supervisory review. They are treating AI as a person. This is the one that you're seeing lawyers get in trouble about. Don't lie about what you're doing. Most of the AI cases where some lawyers come up with bogus hallucinatory sites, the lawyer's gotten into trouble, not because the sites are no good, not because he was stupid, but because he lied about it. And I'm using he because all the lawyers that I've seen so far have been he's. So remember that you can't lie about what you're doing. There's a duty of confidentiality. And I think this is going to be one of the technical issues where you're really going to want to have a professional there helping you. Because if you give information to AI, it ordinarily becomes part of the training process. A lot of AI functions and a lot of uses of AIs have now gone to the point where they're saying, no, we're not going to use your queries, we're not going to use your information. Bear in mind, some of those are in terms of service as opposed to contracts. Terms of service can be unilaterally changed. It's something that I think you need to pay some attention to. Interesting difference between lawyers and accountants. Accountants have a duty of independence. Lawyers have a duty of loyalty. In both cases, the idea here is that you shouldn't be losing touch of where you're going. Okay, then there are duties to society. And I think here what we're going to do, just very much look at what AI is helping you to do on behalf of the clients and say, this is letting you break some societal rules far more efficiently than you would otherwise have the ability to break them, because AI helps you to do things. You can mislead with AI. You can do some serious harm with AI. And the big issue that we're going to run into here is this will make you more persuasive. It won't necessarily make you more right. And that's something of consequence. So, I close this with a caution. These are the sorts of things you need to think about when you're using this. I think that it's really important for everybody to start using it. Get an idea of how it works, play with it. Don't use it with the most confidential client information you have. But, you know, I have found that I can do a lot that ultimately will benefit clients in a completely arbitrary, using public information kind of way. And I think that's important to do. And again, just as the conclusion, you know, I think that no matter how scary it is, you can't run away from it. It's going to be there. Your clients are going to be using it. Your adversaries are going to be using it. Learn either how to work it into your practice or how to be a prompt engineer. Thank you. I think now we take a break, if I'm not mistaken. Is that correct?
Yes.
Whoa.
Okay, everyone, we're going to get started again. My name is Jen Benda. I'm a tax partner here in Denver. I work primarily in tax controversy, but do a pretty broad amount of tax work. My background is I started out as a CPA, decided not to do spreadsheets all day, every day, and went to law school. So I have a fun time navigating accounting and tax legal issues and working on controversy matters. And Rachel Shapiro is here with us, and she's going to lead us through a discussion of crypto accounting and cases and what we're seeing as far as enforcement. And that's going to be the theme of our presentation. It's going to be a really quick hit. We only have 25 minutes, and there's a lot to cover. But we're going to try to share some experiences with you so you can kind of learn a little bit, hopefully, about how we're navigating some of these issues. With that, Rachel, I'll let you go.
Thanks, Jen, and welcome everybody. Thanks so much for joining us. So as Jen said, we're going to be discussing the IRS's enforcement focus on cryptocurrency and how taxpayers might think about navigating that compliance. So this is just a quick agenda slide. We're going to start with an overview of the IRS guidance that's out there. Then we're going to discuss some, as Jen said, highlight some of the enforcement initiatives that are out there from the IRS and what we're seeing. We'll talk a little bit about remedying noncompliance and some thoughts and reflections that we have on that. And then we'll close out with some additional reflections that we've had in actually helping your clients navigate these rules and come into compliance with the IRS or maintain compliance. Okay, so we thought just as an initial matter, it would be helpful to briefly level set. Two helpful sources of guidance from the IRS, which I highly recommend looking at if someone comes to you and says, oh, I've been doing all this virtual currency, and you're like, oh gosh, I've never thought about this before. Like, read these two sources quickly. It'll give you a lot of information. It's IRS Notice 2014-21 and the IRS Frequently Asked Questions, which are, this is the link to them on the IRS webpage, and then they'll sort of send you off to the various relevant rulings. And just to go through a couple basic principles, you'll hear folks, I guess, use terms like virtual currency, digital assets, and cryptocurrency. There's just a lot of verbiage out there. So generally, we're going to use the terms that the IRS uses them. So virtual currency is any digital representation of value. That's not a dollar or another foreign currency. And it's a broad category that includes cryptocurrency. Cryptocurrency is a type virtual currency that is secured by cryptography. And then digital assets is a broader, sort of the most broad category that includes both virtual currency and things like non-fungible tokens. And just a couple basic concepts. So virtual currency is treated for US federal income tax purposes as property. So that means that if you receive virtual currency, you are receiving property, got to pay tax on that. If you receive virtual currency as compensation, that's ordinary income to you. It might be subject to employment tax or self-employment tax. And when you sell virtual currency or use virtual currency to buy things or pay for services, you're also selling property. And if you exchange one type of virtual currency for another, that's also going to be a sale, typically of a capital asset. So you'll be subject to those same general rules for short and long-term capital gain. The IRS has concluded that there is no like-kind exchange treatment under Section 1031 for coin-to-coin exchanges. So it's important to bear in mind because we think that often for taxpayers, crypto reporting and taxation obligations arise when not everyone expects them to arise.
Yeah, you see a lot of people just not understand, oh, if I take my cash and put it in and buy some coins and then I'm trading those for coins, they think that's not a taxable transaction. And what we've seen in compiling some of this data for clients is, they might have reported the coins that they converted to cash, but they may have along the way, that may have been a $100,000 transaction, but along the way, they may have done $400,000 of transactions. And so it adds up very, very fast as far as what the IRS expects to see on the tax return.
Yeah, absolutely. The one reprieve is that if you have a client, they've got multiple wallets or multiple accounts on different exchanges, and they just transfer coin from one of their wallets to another or one account to another, that at least those internal transfers, those do not trigger tax.
As long as it's in the same currency.
True.
True, yeah.
Yeah.
I actually, well, we're still in crypto, not in, the coin bank or we moved to the other wallet, a different currency.
Yeah, and you do see a lot of movement between different types of accounts because there were exchanges that existed, then shut themselves down to US customers. People have a hard time getting that data. So there's a lot of movement around, and it's, we see people that have used like 5 exchanges and 3 different wallets, and trying to keep track of all that is incredibly complex.
Especially 5 or 6 years down the road, and especially if some of those exchanges, like Jen said, have shut down since.
Right.
Okay, so this is just a quick, there is other IRS guidance out there, sort of gets more topic specific on hard forks or staking, charitable giving. The IRS website on digital assets has a nice list of guidance that's out there, but you should just be aware that it's not a long list, but there are additional resources that you should take a look at if you are interacting with virtual currency transactions. And then always, it's a good idea if you, or if you're working with a taxpayer that's facing proposed adjustment, consider the timing of any IRS guidance that is relevant to your client's case, because it might help you build a case to abate penalties if the tax return was filed before the relevant guidance came out. Okay, so we'll get into enforcement initiatives. The first one we wanted to talk about is the IRS announcement from September 2023. So this came out, the IRS announced a major expansion in high income cases through the High Wealth, High Balance Due Taxpayer Field Initiative. As part of this initiative, the IRS is going to intensify work on taxpayers with a total positive income of more than $1 million that have more than $250,000 in recognized tax debt. And at the same time, the IRS simultaneously announced that the digital assets would be a priority area for targeted compliance in the fiscal year 2024. As you'll see in the next slide, we're going to talk about the IRS's efforts to gather taxpayer information through the use of John Doe summonses that have been issued to virtual currency exchanges. The IRS found that an initial review of records produced in response to those summonses showed the potential for a 75% non-compliance rate among the taxpayers that were identified in those records. And so the IRS is, not surprisingly, projecting that more digital asset cases are going to arise and be developed in early 2024.
Yeah, and what the IRS is doing is getting this information and sending notices. And they refer to these, they've started referring to some of their compliance initiatives under some terminology such as soft letters and work streams. And they're really trying to get people to fix things themselves rather than having to chase things down. And so they're sending out letters that say, hey, here's all these transactions we know you engaged in. You want to amend your return? And I think the important part of those types of efforts is to make sure clients aren't ignoring them. These letters will, assess tax. And if people don't respond to them, there's going to be a 90-day letter, and someone's going to have to go to tax court if they're not paying attention and if they disagree with the balances. So it's very similar to what we used to see, and I think it's changed on 1099Bs now that we have basis reporting on 1099Bs, but you really just used to have those gross proceeds. And so if the IRS sees gross proceeds on the 1099B, it's going to do a matching letter, send that out to taxpayers, assess some tax, and you have to go back and report your basis. And so that's going to be the same hole that we're going to see in these notices, and that's where taxpayers are going to need to gather all this information so that they can go back to the IRS and say, yeah, I know I engaged in all these transactions, but here's my basis and here's the real gain or loss. I mean, depending on what year you're looking at, I think everybody knows crypto went like this and then went like this. So depending on what year you're looking at, you've got potential tax exposure, but later years, you've probably got a lot of losses sitting out there. But if there's, $1 million of proceeds related to a loss year, taxpayers are really going to be motivated to find that basis information and circulate it back to the IRS.
Yeah, we had a client, the IRS got sent from Coinbase a 1099K reporting only gross proceeds, something like hundreds of thousands of dollars of gross proceeds. And this was a client that had done a lot of transactions like on their phone or something and actually had a net loss. But because it was really challenging time to get the information that the client needed from Coinbase to respond to the IRS completely, the IRS sent the 90-day letter, and ultimately we got involved and had to go to tax court and file a petition, all ultimately to substantiate basis that the IRS would agree that there was no deficiency in the first place. But it is a lot of rigmarole, and I think it's hard. It can be challenging for taxpayers to find and understand the full gamut of information that they need to provide to the IRS to get these disputes resolved quickly. So, okay. So I had mentioned John Doe summonses. So these have been issued to now 4 different exchanges, cryptocurrency exchanges, by the IRS as a way to collect information about taxpayers that are transacting in virtual currency. So Coinbase was the first such exchange. It received a summons in 2016. It tried to fight it, and then ultimately it was enforced in 2018. And that summons targeted all US Coinbase customers who had transferred convertible virtual currency equivalent to at least 20 grand in any one year from 2013 to 2015. Another John Doe summons was issued to Poloniex in 2021. Again, this targeted US taxpayers who had conducted at least, again, 20 grand in transactions in cryptocurrency during the years 2016 to 2020. SFOX got a similar summons in August 2022, seeking information from the IRS, seeking information about US taxpayers who conducted at least 20 grand in crypto transactions between 2016 and 2021. And then actually, that just a month later, another John Doe summons was issued to NY Safra Bank to produce similar information that was targeting customers who had used NY Safra Bank's banking services that had been offered to SFOX customers. And then most recently, Kraken, just in November, so last month, announced that it would turn over user information to the IRS after fighting over a summons that had been issued in 2021. And this one had also targeted US persons who had transacted in at least 20 grand of crypto in any 1 year from 2016 to 2020. So you can see that those years are changing, but the threshold that the IRS is looking for is, transactions up to 20 grand in any 1 year, which is, I think, ultimately not a high threshold for a lot of folks in this space.
Especially if there are a lot of, conversions, coin to coin transactions. And we've seen this story before. This is how the IRS cracked down on foreign bank accounts using John Doe summonses. So it's not surprising. That was a very effective tool for them. It's not surprising for them that they're using it again. And again, it is, as we saw things unfold in that world, getting ahead of it. Now that you know the IRS is getting this information, getting ahead of it if you haven't been compliant is very, very important. And the longer you wait, the more risk you have, I think, of mitigating penalties and any other exposure there might be.
And trying as much as you can to maintain that contemporaneous records as you're doing your transactions, I think is also a helpful thing. There's actually a related case out there, Harper versus Reddick, where a taxpayer received a letter from the IRS stating that the IRS had information that the taxpayer had a virtual currency account and may not have reported his virtual currency transactions properly. And so this taxpayer, Harper, sought a court order directing the IRS to expunge the financial information that it had obtained from Coinbase through that John Doe summons. The taxpayer argued that the IRS had violated, among other things, his Fourth and Fifth Amendment rights. So an unreasonable search and seizure and also violating his due process rights. Harper identified as his basis for, as the court's basis rather, for subject matter jurisdiction, the sovereign immunity waiver in the Administrative Procedures Act, and the IRS moved to dismiss for a lack of subject matter jurisdiction and for a failure to state a claim. The district court ruled for the IRS on the subject matter jurisdiction argument. So it dismissed the case for lack of subject matter jurisdiction, saying that the Anti-Injunction Act, which is in Section 7421 of the Code, was a statutory exception to the waiver. But interestingly, the First Circuit actually reversed the district court in August 2022. It followed CIC Services, which had stated that the Anti-Injunction Act was not key to all activities that improve the IRS's ability to collect and assess tax, but really was just targeted at the actual assessment and collection itself. And so the court found that in this case, the taxpayer's suit challenging the IRS's information gathering authority wasn't covered by the AIA. And that the Anti-Injunction Act just limited the court's jurisdiction in suits involving actual collection and actual assessment. But then, of course, the First Circuit sent it back down to the district court, which then ruled that in any event the taxpayer had failed to state a claim. It had no protectable interest under the Fourth Amendment or the Fifth Amendment, and so now that's under appeal. So I think this is a case that folks are going to be watching in this space. I don't know that anyone's all that optimistic that you get to claim a privacy right, but you never know.
Yeah, I think the whole point was here we have a system of spending money and engaging in transactions that's going to be secret, and I think it was foolish to believe from the beginning that that was going to exist forever, and we've reached the point where the jig is up, and the IRS is going to get all this information, and there's going to be all these taxable transactions to deal with.
Yeah, and speaking of which.
Yeah.
Okay, another enforcement initiative that we want to talk about are the proposed digital asset broker reporting rules. These are under section 6045 and 6050W, and they were released August 25th, 2023. And essentially, these broker reporting rules are planned to impose broad disclosure obligations on digital asset trading platforms and others about virtual currency transactions. So the regulations, we're not going to spend a ton of time on them. They do a lot of work. They just cover a lot of ground. They define brokers in the context of digital asset transactions. And brokers reach sort of, the definition of broker reaches sort of what you think is like the typical definition of a broker, like the exchange on which you transact. But it also reaches persons that provide sort of facilitative services to the sales. So this can be payment processors, it can reach certain wallets. The definition of brokers for this purpose is pretty broad in the proposed regs. The proposed regulations identify the types of sales that are subject to reporting. They identify all the information to be reported to the IRS, including the transaction IDs for the various transactions, obviously the gross proceeds, the type of consideration received, and all that gets reported to the IRS on a new Form 1099-DA, digital asset, and that would start with sales that occur in 2025. And then finally, the regulations also provide rules for determining gross proceeds, determining fair market value and basis. They provide rules to subject these transactions to backup withholding so that folks who are taxpayers that are doing these transactions have to provide their TIN to the exchange. And they also provide rules for identifying which units of a particular digital asset have been sold. So as you can imagine, the proposed regs spurred an enormous response from the community. There were apparently more than 19,000 comments filed in the first month, and the IRS actually ended up extending the comment period for a couple of additional weeks to allow more feedback. And the comments focused on many different issues. I'm just going to give you a few examples. So one thing that has come up a lot are privacy concerns. For example, with having taxpayers have to give their social security numbers over to the exchanges, additional privacy concerns with requiring the reporting of the crypto users' wallet addresses and the transaction IDs, which commentators generally argue are not necessary for the IRS to determine your tax liability, so they don't have anything to do with gross proceeds or basis. Commentators have said that the definition of broker is too broad, that it really shouldn't go beyond what you think of as your traditional broker, or the actual entity or person that facilitates the sale. Commentators have said that there should be a de minimis exception below which you don't have to report. And then finally, I've also seen comments raising similar constitutional arguments under the 4th and 5th Amendment. So, okay. And then this is the last virtual current enforcement initiative that we just want to talk about, which is the inclusion of a question on virtual currency on the IRS Form 1040. In 2019, Schedule 1 to the Form 1040 included the question, at any time during 2019, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? This question was ultimately moved to the Form 1040 itself in 2020 and has appeared in virtually identical form on the Form 1040 every year since, although it was broadened in 2022 to include all of digital assets.
Why don't you switch to the polling question
Yeah.
so people can deal with that? I think that, the interesting thing, my hairdresser is really into crypto, and I talk to her about it all the time. And when they put this question on the 1040, she's like, I don't do that many transactions, blah, blah, blah. I was like, just be sure you correctly answer that question, because we've seen this story before. In the foreign bank account world, there's a question on your tax return. If you marked, no, I don't have any foreign bank accounts, and you did, some courts have found that that was a sign that you willfully misreported things, and that's not good when you're trying to get out of IRS trouble. So very interesting. I think that this world is a little bit different from the foreign bank account world, but there is a lot of non-compliance, as the IRS knows, and that's where we're headed next, is just talking a little bit about non-compliance. 3 minutes.
All right.
Get
Let's
it out
just go
there.
to the last one. Okay, compliance and practice. So this is just some reflections that Jen and I have had in working with taxpayers who are trying to come into compliance. So I would say one of the biggest challenges that we've both faced across different cases that we've worked on in this space involves getting all the information that you need from the taxpayer. Crypto is not always going to be reported on a W-2 or on a 1099. And so a client really needs to be able to identify every single wallet, every single exchange account that they had in all the relevant years. And as Jen said, a lot of these exchanges can get shut down. So those records can just sort of become completely inaccessible. So as much as you can encourage your clients to be maintaining those records ongoing, that's important. And then once you've got that information, you need to be able to compute the taxpayer's tax liability. And so ultimately, you're probably, the client's going to say, okay, here's all my information, and they'll hand you like 30 CSV files, just raw data. Okay, thank you, figure it out. And it can be challenging to then synthesize that into actual tax liability, but there are accounting firms out there now that are specializing in cryptocurrency accounting, and blockchain accounting. And so we've had some experiences working with those firms, and they can be a really helpful tool to help you synthesize sort of the sheer, just enormous amount of data into.
Yeah, and the other thing they do is they can track these transactions between wallets and exchanges and whatever, and help you identify, like, it looks like there's some missing information. It looks like there's another wallet here that we don't know about, things like that. To me, that's the most useful part of it, because I don't do accounting anymore. I want someone else to go through every line of these CSV files, and that's the really helpful part. And it's great that there's experts, there's software out there that can be used. And so I think those people are going to be making a lot of money because of the IRS enforcement initiatives. So we're happy to answer questions later. We're actually at the end of our time, but thank you all.
Yeah, thank you.
Just go on.
Unless you want to just speak.
No. Well, greetings, everybody. I'm the stand-in today, so if I screwed up, please be forgiving. Tim Crisp was to be your speaker, but he had an emergency, so he's stuck in Santa Fe. So I'm going to cover this fascinating topic for you, the CTA. How many of you, show of hands, how many of you really understand the CTA already? Have really looked at it? How many of you have had clients call you about it? Yeah, this is the problem, is it's happening in 3 weeks and nobody knows it's happening. So I'm glad we're doing this for you all. So anyway, I'm Mark Painter. I'm a real estate attorney from the Boulder and Denver office, but Tim Crisp and I head up the task force for the CTA for Holland and Hart. And we have a big group that does it. And there's a lot of lifting to go with it. So we only have 25 minutes. So I'm just going to zoom through this as fast as I can. And hopefully we'll have a little time at the end for some questions, but if not, I'll stick around if people want to ask questions afterwards too. So what are we talking about? Andy Garcia and a whole bunch of other celebrities are going to have the same reaction that a lot of you have, which is, hey, you've got to be kidding, I think is the main one. This statute was part of the Defense Authorization Bill back in 2021, and it mandates reporting of beneficial ownership in most entities that we deal with. Now, there are a bunch of exceptions we'll talk about later, but a lot of entities, corporations, LLCs, limited partnership entities that have to file with a state entity, a state government in order to be created. And the idea there is to create a federal database of these kinds of entities, but also a database of beneficial owners. And beneficial owners are not just owners in terms of an ownership percentage, but are also people who are in substantial control of the entity. We'll talk about that too. It's not supposed to be information that's available to the general public, kind of like IRS filings aren't supposed to be available to the general public either. The whole idea here was somebody has been trying to bring this statute to the fore in the US, and it just hasn't made it. Similar statutes exist in the first world all over the country, and the United States, which has been pushing for a lot of visibility into the criminal sectors across the globe, has been getting an F grade in terms of its own compliance with the kinds of laws it's wanted to pass. So this finally got slipped into the Defense Authorization Bill, and it's codified here in the federal statutes. It's implemented by FinCEN, the Financial Crimes Enforcement Network. And FinCEN is essentially the military police for the Treasury Department. And they do all this enforcement under the Bank Secrecy Act and similar statutes. This was, I don't think I said this yet, it was in the Defense Authorization Bill, and Trump vetoed it as almost his last act as president. And it was the only veto that was overridden too, bipartisan override of that veto, mainly to get the defense bill through. But this statute went through with it, which is why nobody knew about it. It was kind of discovered 6 months later out in the legal and the accounting industry. Except you'll see the accountants were actually on top of everybody else here in a second. So the beneficial ownership rules have been partially implemented. We're only 3 weeks away. January 1 is when it really kicks in. We still have no way to file with FinCEN. We still don't know what their system looks like. They are woefully behind. So thankfully, as we talked about, we're going to have 90 days after January 1 for entities that get filed after January 1. We'll have a 90-day grace period, and hopefully FinCEN will get its act together during that period. So it's a big change to accounting practices, legal practices, consulting practices, anybody who's working with entities. The three categories that we deal with under the statute are reporting companies, beneficial owners, and company applicants. Those are the three categories you really need to think about and watch out for. Reporting companies will have to report on, we'll look at some specific information they have to report on. But they have to, with their reporting, they have to report on their beneficial owners and submit that information in their reporting. And in their reporting, they have to submit information on the company applicants too. We'll talk about who each of those categories are here in a second. So when does it start? I've talked about January 1. Entities formed on or after January 1, 2024 will have 90 days to submit their FinCEN reporting. There may be, well, I was circulating this morning, there's new legislation that's coming out, bipartisan legislation out of the House to extend some of these deadlines. So there may be some more gap there, but it's probably going to be for the older entity reporting, not this. So we'll probably still be dealing with a 90-day deadline to file reports after you file and create the entity. So your clock starts ticking. It's a 90-day clock after you get a certificate of good standing or certificate of organization or whatever it is from whatever state you're getting. That's for entities formed starting in 3 weeks. For entities formed before January 1, 2024, old entities, they don't have to start filing until January 1 of 2025. There may be an extension on that too in this new legislation. We'll see. That's going to be a real nightmare. You can kind of control your pace right now with entities that you're forming as you go. But every entity formed before January 1, 2024 that you've been dealing with or your clients have, You've got to be looking back at those and then getting all that information in on tons of entities starting January 1, 2025. So the kinds of entities that have to report: most smaller corporations, LLCs, limited partnerships, anything where you file with a Secretary of State. Also, if you file with a U.S. territory or with a tribe, those are kind of anomalies, but also foreign entities that file to do business in the U.S., they're going to be filing with a governmental entity to be created or registered in the U.S. They have to file as well. Trusts, general partnerships, associations, unincorporated associations, they're not going to be required to report for the most part. There's going to be some real confusing areas too, though. Trusts that don't have to report but own LLCs, certain other kinds of trusts, they may have to report. Even homeowners associations are going to have to file. Now, this was a slide for one of our real estate presentations, but oh, that was blocked out. Sorry about that. We gotta talk to the corporate group about that. That's not what my slide said. Sorry about that. But you get the idea. So I'll just move on. That kind of points out the silliness of this statute. If you think about, most of us live in a homeowners association. Some of us have volunteered to be on the board of a homeowners association. If you're volunteering to be on the board of a homeowners association for 3 years or something like that, you actually will have to file with FinCEN, because the description of how the statute got to where it did was that what we're going to do is we're just going to take a shotgun approach, and we'll talk about exempting entities later. And this was a low priority for them, homeowners associations, but people are losing their mind over homeowners associations. There are other entities that are kind of in the same boat. So a number of entities are exempt, and we'll go through some of the exemptions here in a second. You're exempt only so long as you meet the qualifications for being exempt. Once you no longer meet the qualifications for being exempt, you have 30 days to file, which is going to be tricky for a lot of our clients to actually be thinking about that. And for any of their accountants, their attorneys, any of their consultants to actually know that something has happened that's triggered that they have to file. If you are no longer required to file, you can file saying I'm out too. So there's a yo-yo provision there, both directions. So what kind of entities are exempt? Large businesses, this will be the one that most of us deal with, is entities that employ more than 20 people. And this is a conjunctive list. Entities that have more than 20 employees in the US, and entities that have a US physical presence, and they filed a federal income tax return for the previous year showing at least $5 million in income. The issue here is that a lot of entities that will be large entities or might start out as being large entities don't really start out as a large entity because they can't meet the tax return thing for the last year because they don't have a tax return yet. Inactive entities, they don't have to file, but there's some kind of odd rules there. You have to qualify for being an inactive entity. You have to not have engaged in any business, and you have to hold no assets, and you have to have no foreign ownership in the last year, and you have to have not received more than $1,000 in reportable income in the last year as well. The question though is on this, sorry, I skipped through too fast. If you're an inactive entity that became enacted between 2020 and 2023, you still have to report. And we're not sure why exactly that's the case, other than the timing of when the statute was adopted. Some of these you still have to report on, even though they are enacted. So, regulated companies don't have to report either. Public companies, insurance companies, banks, these larger companies don't have to report because they already are reporting through their other filing systems. Tax exempt entities, this will be one of the key ones, is 501c type entities don't have to report either. But again, you're not going to qualify for being a 501c for at least 90 days. Or take, how long does it take to get your 501c status letter back from the IRS after you incorporate it? It's not going to be within that 90 days. So a 501c entity is going to have to report at least in its first year. And then another very important exception is if you're a subsidiary, if the entity is a subsidiary of an exempt entity, it's not going to have to report either. This is why I said you accountants were paying attention early on. Accounting firms are exempt, regardless of the size.
Maybe.
Maybe? Yeah. It's now a maybe? Okay.
Well, you have to be regulated by the CCAOB.
Okay.
Yeah.
Okay.
So a lot of small accounting firms,
Will
the
not,
smaller you are, the more likely
you're going to be in there. Well, at least there was an exemption for the accountants that nobody got for for lawyers at all. So lawyers, law firms will be exempt only based on the large company exemption. Certainly not on the nonprofit exemption. So, what do you have to report for a reporting company? Reporting company has to report, it's very simple and straightforward. Entity name, trade names, address, EIN, jurisdiction of formation, all pretty straightforward, non-provocative. Individuals, though, now when you're reporting on the filing on the reporting individuals who are beneficial owners, the qualifications are they have to have at least 25% ownership. Anybody who has 25% ownership or more would be considered a beneficial owner, and they would have to file a report. Or, and when you calculate 25% ownership, you got to take into account warrants, options, things like that too. So there's a lot of there are a lot of rules around that too in terms of adding up the ownership interest. The other category of beneficial owner is somebody who has substantial control. Substantial control can be the obvious. They can be an officer. They can be a director. Based on some of the language in the regulations, general counsel is by definition going to be a person with substantial control. LLC managers, those are all going to be considered, generally going to be considered people with substantial control. But it goes beyond that too, to cover people who have that kind of control without having the title. The title isn't what's so important. So what does the beneficial owner have to report? They have to report their full legal name, date of birth, complete residential address. And then, even though it is not in the statute, it is in the regs. A passport or driver's license information plus photos from those. And we'll talk in a minute about an option to that, but where we're seeing it in a law firm that's going to be a problem is how do we get that information? None of the organic documents for our company clients really have information that forces these categories of people to provide that kind of information. So we can see a lot of resistance from owners, directors, officers saying, I don't want to provide that. One point we've made is to say, I don't want to give the government my passport, and that's a lot of information. It's like, well, Who do you think issued your passport? So, but the response to that has been, yeah, but that's not associated with my company interest or my real estate interest or anything like that. Now we're connecting those things. That's the point of the statute. So the other category of person who has to report is going to be the company applicant. And this likely means you, if you're working with a client and you're forming the entity or helping them with the formation of the entity, the company applicant, simply stated, is the person who forms the entity on the Secretary of State website. If you're the person who hits enter for the formation of that entity, you're going to be a company applicant. You think of it in the law firm as the client calls me, we're doing a deal, we need to create an entity. I direct my paralegal to form the entity, and my paralegal is going to be deemed a company applicant because she's the one who sets it all up on the system. I'm the one who directed her to do that. You can only have two applicants, two company applicants. You can't have three, which is nice. But the two of us in doing that would be considered company applicants. And so the information we have to file is the same as what a beneficial owner would file for the most part. So how do you get around that? You don't completely get around it, but you can do it just once. And we still don't know how to do this because the system isn't set up yet, but you can get a FinCEN identifier. And you enter all that information with FinCEN one time, and you get a FinCEN identifier number. And then with that number, every time you're a company applicant or every time you're a beneficial owner that has to be reported with respect to a company, any company, your FinCEN identifier is individual to you, and that goes in, and you don't have to continue to put this information, this personal identifying information out there over and over. Nor do you have to, the nice thing is, you don't have to share it with over and over with people who are helping you form these entities. You just give them your FinCEN identifier. So, when does the report have to be updated? Any of those reports. Basically, it has to be updated. Great. I'm going to move fast then. It has to be updated within 30 days of a change of any of the information that you already gave FinCEN. That's another place where we have to remember to do it for ourselves, and we're going to have to remember to do it for our clients too. And we're going to have to force our clients to let us know when things have changed. I just got told I only have 5 minutes, so I'm going to move really quick here. If you're filing, then you're certifying. And if you're certifying, you're telling FinCEN that everything that's being filed is true. Willful violations can end up with penalties of $500 a day. A lot of people are talking about getting indemnities within entities for this partner or this fellow member at an LLC not providing the correct information. An indemnity doesn't do you a lot of good if the penalty is prison. So there's also 2 years in prison as one of the penalties. So I'm going to get the images up here. I love this image for this. There are 34 million entities that are implicated. That's the estimate right now, 34 million entities that are filing. Some of you may have seen that the FinCEN sent out a notice of a webinar last week or early this week. Within 7 minutes, it was full and the system crashed. And that's what's going to be happening soon. They estimated $85 per entity to comply with this. It's nutty. And there's no money to enforce it. There's no system for tracking it. There's no system for verifying anything that they're doing, anything that they're receiving. So what's going to happen with the information ultimately? It's just going to disappear. And we think the only way they're going to be able to use the information is if they get a suspicion of someone, they're going to just go digging for it. All right. I'm going to skip this and I'm going to go to a beneficial owners. These are the things you have to enter. Should we do that? We still do it? If I don't do it in the 5 minutes, are we in trouble?
I will be sending a copy of the slide.
Okay, all right. Well, then let's do this one. And we'll do one after that. Let's check and see what you think. The reporting company is an LLC with two managers, individuals A and C. Individual A owns 50% of the membership units, and individual C doesn't own any of them. Individual B owns the remaining membership units, but is not a manager. Who has to report under the statute? You guys do that? Is it coming up? I don't know how long I wait. And keep going? Okay, all right, because this one's way more fun, and then we'll end with this. Because this is the one that really confused me. We're assuming a reporting company at the top, corporation. Corporations own 50% by company Y, 50% by company Z. Company Y is owned 30% by individual A, who's the CEO, 70% by individual B, who doesn't have any officer role. Company Z is owned 25% each by each of these people, but individual A, again, same individual, is CFO. Individual C is the CEO. And then you also have individual F, who directs important decisions through the board, kind of in the darkness. Individual F. These guys don't show up on any of their corporate documents, but they're certainly in control. So, who do you all think has to report? I'm going to come back and I'm going to walk you through this and then we'll stop. Entities that own a reporting entity aren't reporting persons. So you have to look through the entity to the individuals below. This person owns 30% of 50%. So that's 15% overall of the reporting entity. This person owns 70% of 50%. That's 35% of the reporting entity. So they're over the threshold right there of 25%. This person owns 25% of 50%. They're going to be below the threshold, except that's individual A. So that's 12.5% plus 15% over here. They've got 27.5% overall of the entity they have to report. They also have to report because they're a CFO. Individual C has to report not because of the ownership, but because of the control function factor. Individual D and individual E, they don't meet the threshold. They don't have to report. Individual F lurks in the wings, is the puppet master, and makes all the decisions. They're supposed to report. This is going to be one of the tricky things for everybody, is to suss out these individual Fs, because we're going to have a lot of people who actually control things who don't want to have their names on it. So that's it. And I used up all my time, so if you have any questions, I'll hang around. We're good? Okay.
All right, I think we're ready to get rolling again here. So my name is Bill Colgan, and I lead the tax controversy and tax litigation subgroup. And we've got, and I'm super proud of this team. In addition to the team members up here who we'll introduce, we've got two in the audience, Rachel Shapiro, who was up here speaking earlier, and then also Lauren Egan recently joined us. Lauren, raise your hand. Yeah, you'll be seeing her face in our world as her career advances. But as I said, I'm really super proud of this group because those of you that have been coming to this conference for a while, you've seen us kind of growing, and we continue to grow. We now have 8 timekeepers in the group full-time, and many others outside of our little core group. But we speak nationally. We have clients all over our footprint. We have clients nationally. We work on cutting edge issues of all sorts. We do transfer pricing, litigation of all sorts. And we're going to be hitting on some key things today. So the way we kind of think of it is if there's a controversy problem or a tax litigation problem, you know, we're the people you call. If we can't do it, we need to find somebody else. We have people that do SALT specific controversies, not in our core group. We point you to them. But we're the people that if there's some sort of weird thing or problem, including criminal stuff, we're the ones. That's the world we live in, and that's the world we really enjoy. So with that, I'm going to turn it over to our team, our first person, Jen. If you could go ahead.
I've already introduced myself, so I'm going to spare you the 30 seconds and let Bill. Do you want to give your background? Or?
Sure, I'll give a quick background. So I started my career at the U.S. Department of Justice in Washington, D.C. in the tax division, litigating cases. My dockets, as it turns out, Colorado, Wyoming, and Utah. So I was here litigating cases in the federal district court here, just right around the corner. And did that for 4 years. It was the Attorney General's Honors Program. And when I finished the 4-year program, I went into private practice, and I was in Silicon Valley for a number of years. And for many of those years, I was living in Jackson, where my office is, Jackson, Wyoming. And then I joined Holland & Hart. We have a great office in Jackson. I spend time down here as well. I have an office here and couldn't be more thrilled to be building this team.
Hi everyone, I'm Susan Combs, and my career began in Washington, D.C. with the law firm of Arnold & Porter, where I did high stakes commercial and business litigation. And I joined, between joining Holland & Hart in 2005 and my time in D.C., I clerked on the 7th Circuit Court of Appeals with the Honorable Kenneth Ripple. And I've been in our Jackson, Wyoming office for about 20 years now, and I work with this core team in Denver as well as our Salt Lake City, Vegas, and Boise, and other offices that we have. And my focus is litigation, audits, IRS appeals, and sometimes helping clients mitigate risk upfront, get audit ready, for example, through intercompany agreements, having their documents in order, and broad range of issues from worker classification to, we have a business valuation trial coming up before the Honorable Judge Greaves in Salt Lake City in a few months. And so happy to speak with you all today. Thanks for coming.
Oh, okay. Hi, everyone. I'm Tamara Kotzker. I started my career with IRS Office of Chief Counsel in New York way too long ago. And then I moved to Denver. I was there for 17 years in SBSE, so I was in tax court. That's kind of where I live. And I've been with Holland & Hart for about a year, well over a year, doing all the things that these 5 people do. So, Matt.
Hi, everybody. My name is Matt Wright. Before I joined Holland & Hart, I was in the Army for 20 years, the 13 of those with the JAG Corps. Undergrad was at West Point, so I just bring that up so I can say, go Army, beat Navy. Yeah, when you have a 6-6 season, but you beat Air Force and Navy, it feels like you went 12-0. So it's been a good year. But I had a bunch of great jobs. As part of that, I had the opportunity to litigate, but also obtain a tax LLM. Apparently the Army needs at least one tax attorney. You know, I love being here because I was able to just bring those 2 things together. And this is just a great team to be with. So thanks for coming.
Great. So our agenda today, we're going to start off just We're gonna hit some high enforcement areas. So the first one is partnership exams. The second is what you need to know about that ERC. I think, oh, I was missing a bullet, sorry. Foreign offshore reporting and remediating those non-compliant situations. And if we have time, we're gonna do just a quick hit on the Moore case. It's been all over the press. Just give you a highlight of that in case you don't have any background. So our disclaimer, I think you may have seen it earlier, but we've got it in here again. So the IRS focus on partnership examinations. So the IRA funds that were given to the IRS for beefing up enforcement initiatives, we're seeing the commissioner use that as a tool to get out there in the public, talk, give a lot of press conferences, signal things to Congress about what the IRS needs in order to, of course, address the tax gap and all sorts of non-compliance issues that we have. And one of the issues they've announced they're going to be focusing on is partnership exams. The IRS is reorganizing. You may have seen yesterday there were some announcements about that, and I think they're trying to work smarter, and we're seeing the results of that. I think we're seeing that the way the IRS is operating now is a new normal, and it's going to change the game a little. And there's going to be a lot of new things taxpayers need to deal with in terms of non-compliance. The partnership topics we want to discuss are BBA traps for the unwary. We're seeing situations where BBA elections or failure to elect out of BBA is becoming an issue. The IRS announcement on partnership enforcement, and then again, the compliance letter and work streams that the IRS is focusing on. And I just wanted to start out by holding up, I don't know how many of you have seen the taxpayer roadmap. We think this is entertaining because it explains why we exist, right? This is how you deal with the IRS. And I don't think that they're going to be able to make it less complicated, but I think they're going to try to be more targeted.
There is a roadmap just like that for BBA, just if you want to Google that.
So the IRS focus on partnerships. LB&I formed a new partnership audit group, and in September of 2023, they announced they're auditing 75 large partnerships with assets over 10 billion. So, this isn't, everyone doesn't have one of these clients, but I think it's just the start. That's where they see probably the biggest compliance gaps or the ability to get the most enforcement. And then in October of 2023, they mailed compliance letters. So again, this is the soft letter work streams that they're focusing on. And this went to 500 partnerships with over $10 million of assets. And I think it's interesting what they're focusing on is the balance sheet. They're focusing on, did last year's ending balance sheet tie to this year's beginning balance sheet? And when I was preparing tax returns many years ago, there was always things we were putting through as prior year adjustments and pumping them through the M2. And I think we all knew, that's something that the IRS didn't focus too much on. Well, I think they figured out that's something they need to focus on. BBA considerations. I'm sure everyone is pretty much up to speed on BBA, but I just want to start with, the BBA applies to all partnerships now. So the BBA was put into place so that the IRS could collect tax for adjustments to a partnership return from the partnership. So that's the default. And certain types of partnerships can elect out, and those who elect out are essentially going to be working under the old TEFRA model. So the same way TEFRA cases used to be handled is what will happen for people who elect out of BBA if they are able to. So what's the impact of making the election? That is, you're working under the TEFRA framework. You have to make this election on a timely filed return. So we've been getting questions about how to amend returns, and the first thing we have to say is, what did you elect out of BBA? Because that dictates how we're going to amend the return. The question is on Schedule B, question 30. If you don't elect out, amending returns is very complex. And that's one of the things that we're finding that people haven't really digested. So if BBA applies to amend a partnership return, the partnership files an administrative adjustment request, and adjustments are made to the tax return of the partners in the year the AAR is filed. So if you want to amend the 2019 partnership return, you compute the adjustments, and what you do is you compute a credit, and that credit gets taken on the year, the tax return for the year you're making the adjustment. And we had a situation recently where a partnership had converted to a C Corp. So we no longer have flow-through income on the partner's tax return, yet we needed to get a refund for changing a prior year return. So there are some workarounds that are untested that you can read about in a lot of the press. But this is just one of the issues that, you know, the first thing we ask the accountant is, did they elect out a BBA? And they can't even answer that question without looking at the tax return. So we just wanted to highlight this as something that we're seeing people not pay attention to, and we want to be sure people get on top of it.
I just want to give you a real life example where our client, well, the accountant was just shocked. It was a husband and wife that filed a partnership return and didn't check that box. And they had no clue that they're now in this BVA regime, so.
And this is the same case where they converted to a C Corp, and so they have very little income flowing through to the current year returns, and what you have is what's called a suspended refund. There's really no way to get that money back. So there may be a way to time the filing of the amendment so that you can make sure there's a tax liability that can be offset, but you're just, a lot of things are out of control when that happens.
Yeah, and just a conceptual point about these. So like before BBA, the audit world, it would be like corporations and entities. And then, so that was like a normal audit. Lots of people understood in the IRS how to do corporate and individual audits. It was kind of the same procedures. And then there was this alien world of TEFRA that nobody understood if they were in this other world. And then the TEFRA folks only understood their world. And what BBA did was essentially made the audits more like corporate and individual audits. So
tried to.
Yeah, tried to. Yeah. There's that. But you know, you think about like LB&I does the largest companies. They have lots of trained auditors and specialists. So you can throw in an auditor that has expertise in a particular area, and they're not going to be flummoxed by TEFRA anymore. So those audits, they're going to go deeper. You know, so they're not going to. There's no longer going to be this world of, oh, TEFRA's over here, I'm not going to try to understand it. And so it's really, and we've seen early signs of this being a big deal and moving quickly and putting agents that are, we had one that was completely green. The person, it was his first audit and it was a partnership audit. So yeah, it's a huge change in our world.
So your polling question is up here. That's the end of my remarks. I'm handing it off to Tammy for covering the employee retention credit.
I just want to share too on these BBA exams, they are lasting a long time. Often the first thing they ask for is a statute consent. And a lot of times the agents are not familiar with these BBA rules. So if you know what you're talking about, you get an advantage right from the get-go.
Yeah, and just on that statute extension, they want 2 years, right? They want 2 years statute remaining before it goes to appeals. So, you know, most audits start after the 2 years has started to run. So this statute extension thing, and it's like a black and white thing in their mind. It's like sign this extension or we're just going to give you a statutory notice and you're going to tax court. So it's much different than the dynamics we've experienced in the past.
So if there's any discussion on making those adjustments of credits and the carry forward so they don't evaporate. I have a client that the accounting firm made a mistake and they're considering suing the accounting firm because it was a sale transaction, but they sold their company and over-reported gain on day one.
Yeah.
And now we have, the company's gone, the source of income is gone, right? So now you have this adjustment for some year.
that the ABA has written a letter about it, and maybe the AICPA as well, but as far as I know, nothing has been done. I think the problems that we're seeing indicate to me there's gonna have to be some legislation to change things up, because there's got to be some arguments out there. I haven't figured out what they are, that this is just not right in terms of your overall tax liabilities. And to me, the real problem is mismatching the year the tax hits and the year the income hit. And there's the statute of limitations issues that are bound up in that seem pretty complicated. So TBD is my answer.
We reached out to at least one specialist in Irish National Office who's basically said tough luck. So they're aware it's an issue, but no, TBD.
Well, their job is to follow the law and tell you what statute says.
Hey, we go from BVA to employee retention credit. Some of you are probably sick of hearing about this, but yet it remains a hot topic, so we thought it was worth discussing. Just a show of hands, how many of you were asked by a client to perform an ERC analysis in the last couple of years? Asked, okay. Were any of you maybe that didn't prepare an ERC asked to prepare an amended return, amended income tax return? Okay. And how many of you were just like, I don't want to know about this. This sounds slimy, and just stuck your head in the sand? Okay. Fair enough, and I think that was my approach. When I came here, Jen was like, I need you to look into this ERC thing. And I'm like, what is this? So here we are. So this just kind of lays out the guidance that the IRS and Congress issued. So the ERC kind of came piecemeal. It was fast and furiously issued via legislation in the CARES Act, early 2020. Almost a year later, the IRS comes along to issue Notice 2021-20. And any of you that have done any work in ERC know that's kind of always your starting point for the ERC analysis, is this notice. Congress then issues 3 more laws that modify the ERC rules, and then IRS issues guidance. In the 3rd round of laws, the American Rescue Plan, the Congress codifies the ERC at 3134. Oh. So I mentioned when I started, which was about a year ago, Jen's like, start looking at this ERC thing. So I do, and I'm like, oh, okay, I understand what this is. I start hearing about it on radio advertisements. Late night, watching TV, you start seeing ads for ERC, and I'm kind of overwhelmed with it now that I know what it is. That continues. In October, the IRS issues its first notice about the ERC. November, you have another one, and those ads kind of start dying down. In March, ERC makes the IRS's top. It's the very top of the Dirty Dozen list. So those ads kind of are dwindling a little bit, and the IRS just continues to issue kind of like warnings like, hey, be on the lookout for these ERC scams. July of this year, it issues a GLAM about supply chain disruptions. If you haven't read it, and you have any clients that claim an ERC based on a supply chain disruption, it's worth a read, because the IRS goes through 5 different scenarios, and under every one of those, it's denied. So it's, again, worth a read. Again, throughout the summer, the IRS just continues to issue guidance like, hey, be on the alert. These ERC, they're often referred to as mills, but it's just a bunch of third parties that kind of popped up overnight, marketing this to small businesses. The IRS is like, warning clients, taxpayers, this could be a scam. So in July 27, they update the FAQs. In September, this was kind of a big deal. The IRS announces a moratorium on processing ERC. So basically a pause. If you haven't got your ERC in before September 14th, it's just sitting somewhere in an IRS warehouse to be processed. Last I checked, there was over 1 million ERC 941s and 941Xs that had remained to be processed. And last I heard so the moratorium is supposed to end at the end of this year. It likely will continue in through January. So if your clients got them in before 9/14, they could be being processed. After that, they're just sitting there. But what we've been hearing from clients is that nothing's being processed. And if you call the IRS and ask what the status is, whoever answers the phone saying, we're not processing them. And they're not really looking at the date. So that's not correct, but just know that that's out there. Finally, in October, the IRS says, okay, we are going to issue this voluntary withdrawal process, which is, again, kind of a big deal. We'll kind of talk about that later, but it's a way for clients who haven't got their refunds yet to withdraw it, basically with no penalties or any other kind of adverse consequences from the IRS. November, it's a CCA comes out on OSHA communications. Basically, it's a pretty long legal opinion that says if you relied on OSHA recommendations or their guidance that said you had social distancing and these other restrictions, and that's your only basis for claiming the ERC, you're out of luck because that's not a governmental order. So again, recommend reading that because it's also gives some insight into what the government considers a modification and a full or partial suspension of operations. Finally, just in December, the IRS announced that it was issuing 20,000 letters out, basically for false or fraudulent claims. Hopefully these were none of your clients because these were all based on companies that didn't exist or fictitious employees.
That was the low-hanging fruit, it seems like.
And why did I bore you going through all this? I do this because I think the IRS is definitely, the message is out. They are auditing these. And if your client claimed this and is going to try to argue reasonable cause, I think it's going to be a tough road when the IRS has been, marketing and putting guidance out there that, hey, this is a problem.
Well, and if they give you the chance to undo your bad deeds and you don't do it, and then they come audit you, it's not going to look good.
Yeah, we were at a civil and criminal penalties conference put on by the ABA in Las Vegas, the 4th last week, and I remember hearing somebody say that the ERC situation is perhaps the biggest event of fraud in IRS history. So it is a hot topic.
Yeah, I think last weekend we heard that the IRS has already processed more ERC claims 3 times the amount that the CBO budgeted for it. So it's a huge issue. This just kind of, because there's those 4 pieces of legislation that were issued concerning ERC, this just summarizes the difference because they came out piecemeal. So there's differences for the ERC in 2020, in 2021. The big differences are that in 2020, to be considered a small employer, you had to have less than 100 full-time employees. And in 2021, you only had to have less than 500. If you had more than that number, you could only claim qualified wages for paying employees not to work. So this is really targeted at small businesses, but in 2021, they expand the businesses that are eligible for it. Other huge difference is in 2020, for the whole year, per employee, you can claim a maximum of $5,000 credit per employee. In 2021, that bumps up to $7,000 per employee per quarter, so up to $21,000 if you're eligible for all 3 quarters. And so there's 3 different ways that you can qualify for the ERC in 2020. In 2021, the first one is the subjective way, in that the employer has to experience a full or partial suspension of operations. You're gonna have to look at the IRS notices that have come out to really dive into that, but it's a very subjective, smushy test, even though there's some IRS safe harbors in there. The second way is an objective test. Smushy, that's my technical term. So then the second is a very objective test. This is my favorite because it's very easy. You either have to have a 50% decline in gross revenues in 2020, or in 2021, per quarter, you're looking at a 20% decline. And you're comparing those quarters in 2020 or 21 to the same quarter in 2019. And I say it's straightforward, but again, you got to read the IRS guidance, because in 2021, there's different ways you can evaluate which quarters. There's different tests. And then the third is a qualified startup recovery business, and that only applies to the 3rd and 4th quarters of 21. So quickly, because I know I've gone over here, just kind of what we've been seeing problems on the gross receipts test. It means it means gross receipts. So we had a client that came to us, their gross receipts didn't really decline, but their expenses just shot through the roof during COVID because of COVID, right? They were paying employees more, and They had all these other expenses for dealing with social distancing. So their net income decreased, but their gross revenue didn't. Well, they don't qualify for this. So maybe that's obvious to you guys. I was a little surprised. You got to use the same method of accounting. There's this whole thing with PPP loans. You got to consider whether that was backed out of gross receipts, and there's a safe harbor for that. We've been hearing in audits, the IRS is not happy just to look at the tax returns. They want your financials. They want general ledger detail. This morning I was on a call and I was told that the auditor wanted the bank statements as proof that the client, was entitled to this gross receipt. So I say it's an objective test, but you better have the documents to back it up. So this is the smushy test. And it really is, if you go through the guidance, there are some safe harbors in there, but it's also a facts and circumstances test. So basically, I'm going to give you an example. During COVID, I get my nails done, love going to get my nails done. For a while, the nail salon was shut down. They experienced a full suspension of operations because of COVID. Okay, that's pretty black and white. They qualified for the ERC. Fast forward to August of 2020, they were allowed to open, but they were subject to social distancing and all these other requirements. So where they used to have 20 people in a room doing nails, now they can only have 5. Well, do they qualify? They experienced a partial suspension of operations, right? So these are the things that we're being asked to look at, not the kind of black and white. And there's other examples, but if you're going to go down that road with your client, again, you better have the documents to back it up. The IRS really wants numerical data, not just narrative. So in that example, what you could show them was, well, our employee hours in 2019 were X, and in 2020, after this government order, they were Y. And if that satisfied the safe harbor test, you'd be good.
Or just showing, in 2019, we were able to do this many people's nails every day. And in 2021, it was half of that. Some sort of data that supports, yeah, we were operating, but we couldn't operate at the full level that we could before COVID.
Now, does that mean if you don't have that data, you don't qualify for it? No, it's a facts and circumstances test. But if you get audited or your client gets audited, that's what the IRS is asking for. And again, I was on this call this morning, and it sounds like these audits are just really long. You provide a bunch of information, and then they come back and want more. So I do call this a squishy test because this is, the IRS does not like this test. Another issue where we see problems is an aggregation. You have to apply the aggregation rules if you have any kind of commonly controlled employer. So in a lot of the analysis we were seeing from these ERC mills, they didn't even ask the employer, do you have any related entities? There was just that question that just wasn't asked. So big problem. If it applies, you have to consider it for the full or partial suspension, the gross receipts. And this is where I've seen the most abuses in calculating the number of employees to see if they qualify as a small or a large employer. I think I just shut it off. So again, these are just some of the things we've been seeing. The fraudulent claims, hopefully none of you guys have those. Failure to apply aggregation. On this small versus large employer, the IRS is asking for payroll records in 2019, which I think seems straightforward, but our clients have had problems going back to produce that information, and just lack of documentation. So the IRS normally would have to enforce these through an erroneous refund suit via DOJ. You can imagine that would be very cumbersome and time consuming. Via regs that the IRS has issued, they now can treat an overpaid ERC claim as an underpayment, which allows them to assess it and gives them all their normal, collection mechanisms. So you go through an exam. If you lose, they can go ahead and assess it and collect it just like they would an assessable penalty. They also can still do erroneous refund suits or offset. For those of you who don't know, the 941s are deemed filed as a 415 of the following year. So even if it's Q1 941, it's actually not deemed filed to the following April 15th of the following year. That came as a surprise to me. There's 3 years for the IRS to make this assessment. For the 2020 and Q2 of 2021, so, and I just wanted, there is a typo in here. So I have April 15th, 2024. That's correct for 2020, but for Q1, Q2, 2021, it would be April 15th, 2025. 3031 extended the statute of limitations to 5 years for Q3 and Q4. So the IRS will have until April 15th, 2027. There's this withdrawal process. If you have a client that hasn't received their refund and you think that they're eligible.
Or hasn't cashed the check, right?
Yeah, they can't physically
Yeah.
cash the check. It's worth considering or having a conversation with them. And the IRS has said now multiple times that they're going to be coming out with a voluntary disclosure practice or process program for those that did cash the check. So be on the lookout for that.
In the conversations we heard at this ABA meeting about a potential voluntary disclosure program were really interesting because people were hypothesizing that the IRS is really going to have to give people some financial incentive to enter those programs. It's not just give the money back and walk away. Like they were saying, there's going to be a haircut or things like that in order to get people to really incentivize to participate. So I think it'll be interesting. The IRS has been saying they're going to come out with this voluntary disclosure program for a while. People have been waiting and waiting, and now we're like, when is it going to happen? It'll be really interesting to see how they come up with that program and whether they really are going to let people get away with it to a certain extent, so to speak. So
Yeah, and sometimes when they do voluntary disclosure programs, the first program that comes out, we don't like it. And it's because it requires extraction of some pound of flesh, right? And then the next version of that gets worse and worse, so we might see, this is large enough scale, it's like on the scale of the FBAR stuff, that we might see some sort of escalating compliance initiatives like that. So it's going to, usually people who come in first are the ones that are in the best position.
Right.
Matt and I are going to talk about, give you a refresher and identify some new developments related to helping clients who need to come into compliance with reporting offshore bank accounts and other assets.
Which we're seeing a lot of.
I was going to say that, yeah, we're actually, while this has been around for some time, we continue to have clients coming into us who were either not aware of the reporting obligations, even though they used a tax preparer, or they were not aware that they had an account that fell within these rules, or perhaps they are not as familiar with FACTA and what type of investments that are offshore that they need to report. So we'll start with a polling question. I think it's a pretty straightforward one. FBAR is a commonly used term, but technically it's not the name of the form. So you have 4 options there. FinCEN 114, that refers to the Financial Crimes Enforcement Network, and the FBAR reporting requirements come under the Bank Secrecy Act, which is actually Title 31, but FinCEN has delegated the enforcement of the statute to the Internal Revenue Service, which is why it comes within the purview of tax. We also have Form 8938, 3520, and then the Beneficial Ownership Report. I'll give you a clue that you heard Mark a couple sessions ago talk about the new CTA requirements tied to beneficial ownership reports. And even further clue, it is FinCEN 114. Okay, current options. These are the IRS sanctioned, IRS published programs. If a client comes to you in need, they've identified that they are in violation of a reporting requirement. They're a U.S. person, they're a resident of the U.S., or even they may reside abroad and become aware of these requirements. They fail to comply. Often we're seeing it for several years, there's a lack of compliance. What do? How do you advise them? I can tell you that on this list, you do not see an approach called do nothing. That would, we have, that is not the course that we should be recommending to our clients, because there are severe penalties that can attach to violations of these requirements, and even at times criminal sanctions, including imprisonment. So a do nothing approach is not what we should be recommending to our clients. So the programs are streamlined filing compliance procedures, the criminal investigation voluntary disclosure program, the delinquent FBAR submission procedures, and a similar program for delinquent international information return submission procedures. An overview of the streamlined filing compliance procedures. This is a relatively newer program. It replaced something called the OVDP, which is a previous program that the IRS had. There's two tracks. You can have a client who is a U.S. resident. That would be the domestic offshore procedures. And you could have a client who actually doesn't reside in the United States, and that would be the foreign offshore procedures. They're very similar procedures. The common requirements for being eligible for this program is that it's only for U.S. individuals and estates of individuals. And this is a big one, and we'll talk about it a bit. You have to be able to certify under penalty of perjury that the failure to disclose these foreign accounts was non-willful. And the client cannot currently be under IRS examination or criminal investigation for any activity, not just related to the reporting of these accounts. This streamlined procedure, as I said, it has to do with non-willful. Matt is going to walk you through what is non-willful and what is willful, and what are some indicia of willful. I will add that this presents a legal question. You're taking a legal standard of willful versus non-willful. It's a defined term, and you're taking the facts. These determining a client's eligibility for these programs requires a significant amount of factual inquiry with the clients, with their preparers, obtaining bank statements, bank records. So then you're applying those facts, and often this is where a lawyer should get involved, is to say, do we think that you're meeting the threshold for willful or non-willful? And that's important because the IRS is enforcing streamlined submissions that don't qualify as non-willful. And then you have a worse situation because now the penalties are escalating, and you have criminal exposure for committing perjury by trying to say that you're non-willful. Why would clients want the streamlined program? Because of course the penalties are significantly less. So it's to their benefit to be non-willful.
So I've seen people get tripped up because they didn't get the right advice, and the willful certification was just, I was not willful. That's not the way you do your willful certification. You spell it all out. You say what happened. You say, this is when I learned about this. This is what I did. I mean, it really needs to be a fact pattern of, I didn't know. I discovered, I hired a lawyer, and I did this to remedy everything. And so everybody has different facts, and you really do have to walk through a very deep analysis. And, if we get cases sometimes where they didn't do the first draft the right way, that's when we're going back and trying to basically redo everything and having to go to a different part of the IRS to try to get through whatever disclosure process they're trying to go to.
Yeah, and it's evolving area because when all the FBAR stuff first hit in the late or 2008, 2009, whenever the enforcement really kicked in, there was no guidance. There was no IRS guidance and there was no case law guidance that was attached to this. But now we've got some IRS guidance, but also there's been litigation on this. And that's why a lot of folks in the CPA community are referring things to us on the willfulness, because we're diving into the cases. And Matt will talk a little bit about those developments.
Absolutely. And the sites to the forms that lay out the detailed factual narrative that you need to provide are in these slides, which you will receive. The second program is the IRS Criminal Investigation Voluntary Disclosure Program. This program is for taxpayers who have committed tax or tax-related crimes, or they have criminal exposure due to a willful violation. And taxpayers who might participate in this, it's somebody who fears criminal exposure and they intend to seek protection from that. I can tell you that this process is a much more arduous application process. I think the ABA estimated it would take 60 to 100 hours for this procedure. So this is a significant program, but it is an option for the right taxpayer, because they are getting some protection from criminal exposure here. Two more programs. This one is the delinquent FBAR submission procedures. This is for taxpayers who, they don't fit into the streamlined filing procedures, which can be a bit cumbersome. They certainly don't have criminal exposure, but they still didn't file their reports. They're not under civil exam or criminal investigation. They haven't been contacted by the IRS. This is often where the taxpayer has reported the income, like the corpus or the interest from the foreign accounts, but they failed to disclose it on the information returns, or perhaps there's a de minimis situation happening. So this is a option in the right circumstances. A very similar program exists, not for FBARs, but for international information returns. So think Forms 3520, Forms 5471, and other type of forms. Which procedure should my client use? Again, it often requires a legal analysis after in-depth factual analysis. It'll depend largely on criminal exposure, and it'll depend on the client's, the taxpayer's tolerance for risk and their desire for certainty, as well as the penalty exposures that they may face. And with that, I'll turn it over to Matt to talk some more about the willful, non-willful that we begun discussing.
Thanks. So willful, in these FBAR cases, this is an ever-present factor, and it's a difficult factor to deal with because, like Jen and Sue and Bill were saying, even when you drill down into all of the facts, it can still be very, very gray. And I think sussing out willfulness can be oftentimes more art than science. And what complicates the situation is that depending on the context, especially criminal sanctions, civil penalties, and then maybe streamlined procedures, it can mean different things. So from the criminal perspective, right, willful, that first bullet, it means what you would think it would mean, right, which is I knew I was supposed to do this and I decided not to do it, right? I did it on purpose. But then we add in willful blindness, which starts to make it a little counterintuitive, right? And so willful blindness, like, is the think of the ostrich sticking its head in the sand, right? There could be something here, but you just don't want to find out. And so you don't tell your tax preparer that you have these foreign accounts. You check no on the FBAR questions on Schedule B. You see Schedule B, but you don't read the instructions, right? You're just saying, I don't want to know what's going on here. And that can be willful blindness. So kind of transitioning into the civil meaning of willful, right? We still have knowing, I did it on purpose. We still have willful blindness, but now we're adding recklessness. And so this is important because with knowing or willfully blind, somebody is doing something on purpose. But once we get to recklessness, this is more of a should have known standard. So, we've kind of gotten to the point where willful doesn't mean willful, right? Examples of situations where taxpayers have been found to be reckless for the civil penalty standard are these cases where you can have a large amount of money, right? Because the more money you have in the account, the more reasonable it would be for somebody to drill down into this. You maybe don't even hire a tax preparer. You're doing your own taxes, even though you have these international issues. That can be reckless. You hire a tax preparer, but it's a tax preparer who doesn't have international experience. That's been viewed as reckless. And then always, 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 or almost always, these Schedule Bs come into play in terms of, did you have a Schedule B? Were the boxes checked? No, whether you read it or not, right? Did you sign the return under penalty of perjury? Because you're presumed to know everything that's within the return. Everything on the forms, right? You verified that all of them are accurate, whether you read it or not, right? Whether maybe they're your accounts, but your spouse prepares the return and you just sign it, right? That's still reckless for you to have not read those things because you're presumed to be on notice. And there's also some case law out there where it says, look, taxpayers are presumed to not just be on notice of everything that's in the return, but everything in the instructions to the form. All right. So it can really kind of feel a little counterintuitive in terms of what willfulness means.
And to add to that, the cases are split. I mean, it really does depend on what jurisdiction you're in. Some courts say checking no on the 1040 Schedule B that you don't have foreign accounts is per se. And then other courts say, no, that's just one factor, and that alone isn't evidence of willfulness.
Depends on whether the judge actually reads his own tax return.
Right.
Standards are gonna hold it too.
The breadth of this definition isn't lost on people outside of this room. So the Taxpayer Advocate Service, right, for example, for the last several years has included this as an issue on their annual report to Congress in terms of something that needs to be changed, that needs to be narrowed. Who knows if that'll ever happen or not?
In these concepts like willful, it has a state of mind kind of ring to it, and it's focused on the taxpayer, but so often there's another player. It's the tax return preparer. So like, how do you square all this, those kind of concepts with the fact that there's another person involved? And what's a very typical situation that we see? Well, it was their fault, So the finger pointing, and we very often have conflicting information that we have to sort of resolve in our own minds or weigh in terms of risk. And that's when Matt says it's gray. I mean, it truly is. And we are, we're trained as lawyers to look at lots of facts and apply these legal principles to them, but it doesn't mean the outcome's clear.
So got about a minute left. So Sue talked about streamlined procedures. They use the term non-willful. Hopefully it means the same thing as willful, but is willful from the civil perspective. I think that's most likely the case. But it may not be. And like Sue said, you have to certify non-willfulness under penalty of perjury. What you're certifying is in the block quote there. And ultimately, I think it depends on what the IRS employee on the other end of this thinks it means.
And there's two stages in what we do. There's the assessment and helping advise the client on course of action. So that part, it might be gray, but then fast forward to where it's under scrutiny, we're in a defensive mode, right? We're defending our client, representing our client. And we're advocating in that context. So we often play two roles.
This is the Schedule B. And so I guess what I'll leave you with is it's best to just not even be in this situation, right? So if you have a client and there's any indication that they have foreign connections, just drill down to the impact, right? Even if they don't have bank accounts, you know, if they're a beneficial owner, if they have signature authority, they're on the hook. You just have to really drill into these because, again, in almost all these cases, there's an element of the client saying, "I didn't know," right? And even if they're not affirmatively providing you the information, right, they often say, "I didn't provide my tax preparer the information because I didn't think this was reportable, or I was already being taxed in this foreign country and I didn't think that I had U.S. tax. I just didn't think it was relevant." Right?
Or it might be that we have one where the parent is a signer on their child's account. So they're not getting income or anything of that nature. So never occurred to them.
So I think very often your first indication, right, and maybe your only indication that comes from the client is, you know, hey, I was born in Canada, right? Or I was born in Belgium. And so, you know, it's not just, right, a conversation starter. It's something that you need to identify and really drill down into, see if it's there, and then you can avoid this whole willfulness issue altogether.
We always ask the question, did your tax return preparer give you a questionnaire? And did they do it for every single year? And, you know, if we could just quickly have an update on Moore.
Sure.
Just one.
So for anyone who's not aware of the Moore case, this is a case where a taxpayer was asserting that the 965 repatriation tax is unconstitutional. So this went to the district court, they found for the government, Ninth Circuit same, there was a motion for rehearing and there were some dissenting opinions in there. It's in the Supreme Court, there were oral arguments last week. They were scheduled for an hour and they went to over 2 hours. Pretty much every justice questioned both sides. People are seeing this, they're like, the court is never this engaged in a tax case. And the reason why is there were 30-something amicus briefs talking about the theory that the taxpayer presented, which is that this tax is unconstitutional because it's a direct tax on property. And if you have these indirect taxes on property where there's no realization of money, the argument is essentially you applied a tax when I didn't get any money. So you can see how that realization requirement could in fact impact so many different partnership, any kind of flow through tax, all sorts of different situations. So there were just many, many amicus briefs. And what eased everyone's mind after the oral arguments was that the court seemed very focused on making sure there was a very narrow ruling. They understand that the widespread implications and they don't want to completely disrupt the tax code. So that seems to be something everyone came away with. The other interesting part is that the questioning really wasn't along ideological lines. So we don't think we're going to see like a conservative, all the conservatives ruling one way, all the liberals ruling another way. There might be some interesting bedfellows when we get an opinion. So nobody has any real, I've heard people make predictions. We're not making predictions. We expect the opinion to be issued by the end of June, and we're all waiting to see what might happen. So happy to chat more. Thank you, everyone.
Yeah, thank you all for coming. I think we have some food and we have some other drinks up here, so